Thank you, Anish, and good afternoon to everyone. I see that slides are already up. Oil increasing by almost 8 million barrels of oil equivalent over the next 25 years. That's increasing from a level of around 5 million barrels seen in 2023 to north of 13 million barrels per day by 2050. We see gas and coal commanding the second and third spot. Also, renewables will see another 4.9 million barrel of oil equivalent going forward. Now, as for the oil, which we focus on throughout the outlook, again, it's called World Oil Outlook. We see the global oil demand increasing by another 18 million barrel per day between 2023 and 2025. Of course, the growth is entirely coming from the non-OECD developing countries, which will increase or see an increase of 28 million. But because the OECD will be shrinking by 10 million, the netto is 18 million barrels per day going forward. So yes, there is an oil demand peak in the OECD countries, probably is behind us, but going forward, the scene is commanded by the non-OECD countries, which will see a staggering 28 million barrels growth going forward, and the net of the two effects is a plus 18 million barrels, reaching north of 120 million barrels per day by 2050. Where that demand will be primarily coming from in the short term to medium term, it's China, followed by the Middle East. But as we get into the medium to long term, India will take over the stage. As we see from the left-hand side chart, India will see a demand growth of around 6.5 million barrels, not barrel equivalent, but rather barrels, because we are talking more focused on oil as opposed to energy now. Africa will follow, as well as other Asia, and we see the demand growth going forward is in emerging markets. Now, looking into which sector will demand or manage or dominate the growth going forward, it's petrochemicals with almost 5 million barrels per day. Of that, 18 million barrels will go to petrochemicals. So it's number one growth center when it goes to oil. That will be followed by the aviation and road, which will be around 4 million barrel of growth each. We see other industries growing by a marginal 1 million, while we see the oil use in electricity generation contracting by almost 1 million barrels. Now, again, dive deep into India, because we are in India. We see the fastest growing oil sector in India is aviation, which multiplies by almost fourfolds. That will be followed by the petrochemicals and road transport, which will multiply by threefolds. And then we will see the residential multiplying by 2, almost doubling. This gives you a flavor of which sector will demand more oil in India going forward. Now, how to cater for this demand in India and other parts of the world? We see supply is plenty, is abundant. In the short to medium term, it will be non-DOC, non-declaration of cooperation countries catering to that growth going forward. We see another 7 million barrels per day growth in non-DOC regions, led by US, followed by Brazil and Canada. As a matter of fact, we see the US tight oil, which is the player of the whole picture, increasing by another 7 million or by another 3 million, 2.3 million barrels per day between now and 2029, beyond which we see the US tight oil tapering off. So there will be a peak in the shale oil going forward. As it tapers off to around 15 million barrels per day by 2050, we expect the slack to be picked up by the DOC countries, that's OPEC, plus the members or countries participating in the Declaration of Cooperation led by Russia. So 22 producers under the umbrella of Declaration of Cooperation will pick up the slack, increasing their production from the neighborhood of 50 million barrels per day seen in 2023 to north of almost 63 million barrels per day by 2050. OPEC will be at the center of that stage. Now, that will cost us a lot of money. And in our World Oil Outlook, we quantified the investment requirements need in the oil sector or oil-related sector. Cumulatively speaking, we will need at least $17.4 trillion to ensure that this really sees the light. That's an average of around $640 billion a year. That's a lot of money. Now, the upstream part of it only will be around 14.2 trillion, which is around $525 billion a year. Now, do we see that figure as we speak? Maybe not, and that's why OPEC is always pounding on the issue of investment. We need to invest and invest now to make sure that we avoid price volatility and shortage of oil going forward. Now, we see from the left-hand side chart that the DOC countries will be picking up the slack left behind when it comes to US and Canadian investors who will be maybe fueling or catering to the supply growth until 2029. Now, a quick word about refining. We see an additional 19.2 million barrels per day refining capacity. India likes this because India will be a center for refining capacity building going forward. It will be one of the fastest growing refining hubs in the world. You know, it's major, but it's getting to be more important even further going forward. China will see a 3.2 million barrels per day capacity addition, followed by the Middle East or Africa at 3.6, and then the Middle East at around 2.1. We will see more trade of the Middle East going to Asia. Crude and condensate from the Middle East will increase by 10 million barrels per day, again catering to that growth going forward, but it will be predominantly going to Asia. And on the left-hand side chart, we see Asia import of crude and condensate increasing by almost similar amount. That is to say, OPEC will see more demand, or DOC will see more demand on their crudes, and they will have the resources to do that. But again, it will be mostly south-south trade balance going through the Middle East for the most part, fueling the demand growth centers in Asia. Probably now it's China, but it's turning or handing over the torch to India and other South Asian countries, and then the Middle East and Africa will follow at a certain point in the future. Now, to take care of the uncertainty that we addressed in the previous session, around the base case, which we have on the graph represented by the blue line, we have mapped out an envelope of scenarios for you. The two extremes are a technology-driven scenario, which is the lower one. We see the oil demand potentially dropping to 96. We are not saying it will drop to 96, but we are saying if we are to abide by the climate change target of well below 2 degrees and implement all the technologies that we have today at the cost of the day, then we can manage attending to environment, but probably with a higher investment ticket. But we see oil potentially dropping. That's if we are to use the current technologies and attend very aggressively through policies to climate agenda. Now, what if things are the other way? Then we could render to higher economic growth, more compartmentalized, regionalized markets in which the climate agenda takes the back seat, still render support to the potential higher economic growth using some technology, but the climate is not so high on the importance agenda. We see global oil demand potentially rising to 127 million barrels per day. To leave you, I will leave these probably messages on the slide after the video. But key takeaways is that we will need to address energy security, environment, and development. 3 priorities that need to be addressed at the same time. Policy shifts needs to increase in the rate to attend to the range of uncertainties that we have, as well as the inequality between North and South will be an issue going forward. Most importantly, we don't see a peak in demand going forward, demand for oil. I will leave you probably with, or maybe we can skip the video and take a few questions. All this material is available on our website. Also, the video is available on our website. We'll just take a few questions before we adjourn, and I see the next session lining up. Thank you.
Yes. Please take your seat. Dr. Qahtani, this was a very lucid presentation. Let's quickly go into some questions. You know, as compared to the last World Oil Outlook, this is much more bullish on oil. What are the principal reasons? What has changed?
A lot has changed. Number one, we are talking about 2050 as opposed to the previous outlook. We talked about 2045, so we stretched it by another 5 years just to make sure that we attend to the investment decisions, needs, and render more support to our stakeholders. Number two, we've updated everything else, from the population to the economy to the technology numbers. We added a chapter towards the end of the book on challenges and opportunities, because we see this energy journey, the evolution has a lot of opportunities in it, and I invite you to read the very last chapter. Most importantly is that we have taken serious record of the U-turn policies that we have observed over the past 1 year in Europe and North America and different parts of the world. We've been saying that these green agendas and net zero related LALA scenarios are not credible. They are not going to materialize. We've warned about it multiple times, but I'm glad to see them converging back to the OPEC historically established credible scenarios. And I think in your introduction, you said we have multiple stories. I think we have one main story, which makes a lot of sense, that is credible and it has a lot of numbers and models behind it. And you have the other wishful stories that eventually will have to converge back and get a grip of reality.
Okay, very quickly to Dr. Benyoucef, road transport, we saw an uptick over there, and yet it is going against a little bit of conventional wisdom that we are going to see a lot more electrification of road transport. So where does that come from?
Thank you. Yeah, for electrification or in general the transportation, we see, to go to the more details about the numbers, I would like to highlight that we have a big team of experts working on the modeling and a strong, robust modeling tools that we dig into details of the transportation and all aspects related to the outlook for oil under the able leadership of Dr. Qahtani. And for the electrification, we have also, the modeling of this sector is very important because we go with the detail of the policies, technologies, cost, and so on, and as by region and by country. For the statistic or the data show now that the electric vehicles represent around 2 to max 3% of the total fleet worldwide. Recently, we see a huge increase in the sales for electric vehicles. But if you go to the detail, these electric vehicles, or 65%, come from China. The remaining from the EU and the US. The rest of the world, we have less sales during the recent years. In terms of electrification, for all these electric vehicles, certainly they would need more electricity, but most importantly, infrastructure. And this is one of the challenges of this for the electrification sector, this sector in general in future. And also most importantly, that for the technology, we see also the cost of batteries are, and now at a certain level, but it is less than or more than expected, and the cost. And unless there is a revolution on the batteries, technologies, we would have, in fact, a moderate growth of this, electrification or electric vehicle in general. About the numbers, recently we have around 22 million electric cars in China, which is more than all OECD countries. And in the future, we see China will increase by almost 10 times. And in general, by 2050, the electric vehicles will represent around, 20% of the fleet.
So over a period of time, it's going to be slower than what people normally believe it to be. Let's flip to the supply side a little bit. You talked about tight oil and the US supplies coming down. Is there an alternative to that? Do you see that holding out per your research? And if that's going to taper off, do we have enough supply sources to make up for that deficit, given that overall demand is going to go up?
In short, yes, we have plenty of oil around. In my presentation, I showed that the non-DOC supply is expected to go up by another 7 million barrels before it peaks and then starts tapering off because it becomes difficult to extract or economically not feasible at the market price assumed endogenously within the model. Now, as for the US shale, we expect it to be around 1/3 of the supply growth in the short term, that's between now and 2029. 2/3 will be coming from Brazil, Canada, Qatar, and a few other places. But overall, the non-DOC supply will peak around 2029 and then start tapering off from that point forward. There is plenty of oil, but the market will have to drive the demand towards the lower cost producing countries. That is the OPEC member countries and the DOC countries, predominantly Middle Eastern producers, which they enjoy a very low cost of production. So I think with the plenty of oil in the Middle East, we shouldn't worry about that. But definitely the supply is getting to be more difficult elsewhere, around the world. If you talk about the US shale, we've seen it growing at a staggering rate at a certain point, not very far away before, maybe 2-3 years before the COVID, definitely a year or two before the start of the Declaration of Cooperation, end of 2016. So we're talking about 2014-15. They were growing at 1.4. Now, last year, probably a fraction of that. This year, we see it at less than 300. Probably next year, I'm talking about the shale oil. Around 200, and you can maybe go through our monthly oil market report to get the short-term view in a more granular level.
Sure. Thank you. Given that we are out of time, one last quick question, Dr. Benyoucef. There were lots of refinery closures which were planned or proposed. Given that we are seeing resurgence or resilience of oil per year scenario, do you see that changing?
Yeah, for the refining, we see the medium term around 1 million barrels a day closure. In the long term, between 4 to 5 million. But when you say closures, the refining sector would need 19 million barrels a day as an additional capacity. That means this is the net growth. And when we talk also about the closures, most of them are in developed countries. Most importantly, that closures, that means in fact they closure for definitely this refineries, but rather they will use it for other purpose. Many of them they could be used as terminals or co-processing or for some refineries as bio refineries.
Okay, thank you so much. We are out of time, and there's a wonderful panel to follow with people I have been friends with, and I know that you'll be looking forward to those views as well, which will come from the other side, the green spectrum of the.
We are green.
Okay, we are all green.
We have a lot of green in our outlook, and
right,
and that shows you how balanced our outlook is.
You basically need all of that. Thank you so much. It's been very informative. Thank you again.
Thank you.